Good morning, traders. This is your Forex market commentary brought to you by real ECN. An overview of today's commentary will largely encompass the dollar-yen market. We will examine the yen on both the technical and fundamental fronts, as well as touch base on this week's leading economic report coming out from both the US and Japan. If you're holding any yen positions, I hope that this commentary will prove to be insightful for you to formulating a successful trade. First in line with this discussion, we have the dollar-yen on the hourly time interval. In accordance to the SSI, which is also known as Speculative Sentiment Index, net retail traders' position indicated that the market consensus on the dollar-yen cross has continued to remain bullish. When the dollar-yen cross are sitting at the 102.00 level, there are approximately 2 long greenback positions against the yen for every 1 short dollar position against the yen. The contrarian view would suggest that the extreme optimistic sentiment by the market over one particular currency often hint a near-term top. Analysis of a collection of technical indicators on the hourly time interval on the dollar-yen market is suggestive of a temporary bullish market sentiment and recommend long position on the greenback. The pair opens today's Sydney trading session midway between the established short-term Fibonacci resistance at 102.36, while the Fibonacci support is set at 102.05. The dollar-yen began this week's trading session in a congestion as indicated on the RSI. Nevertheless, the pair continued to remain above the 200-day simple moving average when the cross broke out from this trend line during the FOMC meeting last week. This price action allowed investors to revise the long-term bearish outlook on the yen if it continued to trade above the 200-day simple moving average. This trend holds great significance as 200-day simple moving average contains more or less of 1 year's worth of trading data. However, based on short-term simple moving average, as the dollar-yen pair opened today's Sydney trading session above the 5 but below the 10, 20 and 30-day simple moving average, collectively is indicative of a sell recommendation on the moving average front. This week is packed full of market moving release out from the US and Japan. On Monday, the highly anticipated Chinese HSBC manufacturing PMI is forecast to show a reading of 48.7. On Tuesday, we have the USDJPY consumer confidence forecast at 78.6, while new home sales is forecast at 405K. Wednesday, we have the core durable goods order month-on-month forecast at 0.3%. On Thursday, from the US, we have GDP quarter-on-quarter forecast at 2.7%, while pending home sale month-on-month is forecast at 0.3%. Lastly, we have Friday, from Japan, we have the Japanese core CPI year-on-year forecast at 1.3%, while retail sales year-on-year is forecast at 3.2%. Moving down here, we have the CCI, which is also known as the commodity channel index. It signals buy or sell recommendation on the price action on the dollar-yen, and right now it's sitting slightly just below zero at price value of minus 19.66. The trend pattern on the dollar-yen signal a neutral recommendation ahead of the release of the Chinese PMI number. So now let's touch base on the fundamental front. This coming week risk event for the dollar-yen pair cross will surround the Bank of Japan interest rate decision. Ever since the open-ended stimulus policy implemented by the BOJ during late April of last year, the market had been pricing in this bullish momentum, which allowed the dollar-yen to rally past the 100 mark. Now the concern is how aggressive can the BOJ be in terms of intervening in the market and weaken the yen. If this concern develops into a prevailing risk theme, which is Kuroda taking a step back from upgrading this open-ended program and becoming less dovish towards its accommodative stand, then the market may observe a reversal price action in the dollar-yen. The BOJ did more on a few occasions, mentioned that the Japanese economy is robust enough to grow and meet its CPI target without further stimulus policy. A risk theme that can pose a risk to this dollar-yen strength is concern over emerging markets, particularly the slowdown in China. China can affect Japan on 2 fronts. One, being Japan's largest export market, a slowdown in China can hurt Japanese corporate earnings as well as manufacturing activity. Secondly, this emerging market contagion can potentially escalate it into the beginning of risk aversion, by which can prove to be negative for the dollar-yen pair. The market is paying close attention to today's release of Chinese HSBC manufacturing PMI print. Factory activities are expected to remain in contraction with price value below 50 sitting at 48.7. Risk aversion theme has always been in the mind of investors for the past few months. However, a full-scale risk aversion has yet to materialize. Nevertheless, there are concerns over the excessive speculative leverage position into higher, riskier asset that is deemed to be highly concentrated. These market conditions can observe to be highly sensitive to deleveraging of the Japanese yen-denominated carry trade when a combination of risk aversion catalysts occur at the same time. Therefore, investors are monitoring how the Japanese economy reacts over the coming months upon the implementation of an increase in consumer tax hike for this April. Across in the Pacific in the United States, last week FOMC meeting and the Fed's policy announcement with regard to tapering and changing its forward guidance mandate by lowering its unemployment threshold and moving towards monitoring a collection of leading economic indicators as opposed to just unemployment rate as well as CPI number was nothing out of the market expectation. However, it is during Janet Yellen press conference that she revealed to the press that 6 months after tapering coming to completion by mid-2015, the Fed may be expected to hike rate. The announcement was a wildcard that underpinned the greenback rally across the broader forex market on interest rate expectation. However, the market to a certain extent overreacted as it failed to recognize that Yellen did reiterate that rate hike is subjected to economic condition at that time. If leading economic indicators painted a sluggish growth, that the probability of stalling tapering or remain accommodative are still options that are on the table. The remainder of this month will prove to be relatively quiet post-FOMC meeting, with one market moving release that investors are monitoring, which is the US GDP quarter-on-quarter expected to show a reading at 2.7%. To conclude this commentary, I want to thank all our listeners for spending their time with us, and until then, stay tuned for the next commentary.